Hello there. Good morning. My name is Victor Louis, and I'm the head of investments at Sankore Global Investments. This is your weekly financial markets roundoff. We start off as usual in the US, where stocks closed mixed on Friday, essentially coming on the heels of the first easing by the Fed in 4 years. The Dow inched up by 9 basis points to a new record high. However, the S&P pulled back 19 basis points, while the Nasdaq dropped 36 basis points. However, for the week, the three major averages, notched weekly gains. The S&P rose 1.6%, posting its fifth consecutive week of wins over the last six. The index is up more than 19% year to date. The Dow ended the week 1.62% higher, while the Nasdaq advanced 1.49%. I mean, last week was really all about the Fed rate cuts, which was the first that we'd seen in 4 years. The market didn't quite expect that much of a cut, but the Fed still went ahead and did it anyway. And in post meeting comments, the Fed chairman essentially alluded to the fact that the Fed was really satisfied with the inflation trajectory and was basically now looking to focus on its full employment mandates to ensure that the labor market stays resilient. And it seems like, the Fed was actually able to convince investors and also the market that, the sizable rate cuts that we saw last week was a proactive measure to sustain economic momentum as opposed to a reactive one to, really stabilize it. And in the aftermath of that rate cut, we saw, the market really act very, very, in a very volatile manner. In the immediate aftermath, market up very strongly, but closed that day lower. So obviously, a lot of concerns around the fact that the Fed had implemented a significant rate cut and what implication that had, for the broader economy. But I think the Fed has largely been able to assuage concerns around that and, just basically putting out the message that when it comes to its price stability mandate, it believes that it has done very well and it has attained its set goal there, but it now wants to focus on the full employment mandate that ensures that the labor market stays resilient and doesn't weaken significantly before it starts to react. Going into the rest of this week, really, investors will be watching out for some manufacturing and service sector data, which will be out early this week. That would also give us an indication really of how the economy has been faring in terms of general economic activity. Also, there's quite some this week. Of the Minneapolis Fed will be from this. I think I can look into what likely next moves would be for the Federal Reserve. So the market will essentially be keeping an eye on that to get a sense of how near-term market direction would shake out. Across the pond in England, the Bank of England kept rates steady at its meeting on Thursday. This was following an initial rate cut that it had implemented in August. The bank also voted to reduce its stock of bonds by about £100 billion over the next 12 months. Now, according to the Bank of England, really, a gradual approach to monetary easing felt more appropriate, particularly against the backdrop of elevated service inflation. The BOE expects the UK economy to return to a 0.3% growth per quarter in the second half of the year after exiting a recession in the first half of the year. In arriving at this decision, the Monetary Policy Committee of the Bank of England assessed a mixed bag of data, with headline inflation coming close to its 2% target, but the prices in the service sector, which accounts for about 80% of the UK economy, continues to show signs of elevation. So that created, the scenario for the BOE to hold off on rates for now. The British pound strengthened against the greenback, against the backdrop of the fact that the Federal Reserve had cut rates while the BOE had essentially held rates. So the British pound, basically gained ground and strengthened against the US dollar. And over in Japan, we saw, the Bank of Japan also keep its benchmark rate steady at 0.25%. It's interesting to note that this is the highest rate that we have seen since 2008, really. The market really had expected that this was what was going to happen. However, it expects that we are likely to see another rate hike before the year runs out. The decision came as the BOJ really is striving to normalize its monetary policy after a very long-held, ultra-loose monetary policy, that really hasn't hurt the economy You look at yields on the 10-year JGBs, that's the Japanese government bonds. They were down about 0.4 basis points, while the yen stayed really stable against the dollar. The BOJ governor had hinted last month that the bank is likely to continue to tighten interest rates if inflation and the economy stayed in line with its projections. The tightening stance of the BOJ seems to be an outlier, particularly when most global central banks are towing that path of easing monetary policy. It's important to also recall here that the BOJ had been on this easing spree for the longest, really, and only recently abandoned its negative interest rates in March and raised the key rates to 0.25% in July, particularly as inflation started to surge. It basically reviews that the economy is on track to achieving that 2% inflation target, and this was what led to a lot of the yen carry trade unwinding that also created some volatility in the markets early in August. In Nigeria, last week the Treasury bills market was largely bearish because, again, liquidity remains really, really tight. System liquidity closed at almost 300 billion negative on Friday. So that obviously through the week created a lot of selling pressure. However, there was some cherry picking towards the end of the week that then created a situation where yields sort of declined slightly on average, week on week. For the bond market, it was largely calm. Participants essentially looking towards the outcome of the Monetary Policy Committee meeting tomorrow, and also the bond auction, the outcome of the bond auction, today. So obviously, these are two critical events that the local market will be looking out for: the outcome of that bond auction today, and also the outcome of the Monetary Policy Committee tomorrow. Our expectation is that the committee will hold interest rates steady, seeing as we've started to experience a bit of a deceleration in inflation. Certainly not where we would want it to be, but again, I think that a bit of progress, early days yet, though a bit of progress has been made there. So I think that the Monetary Policy Committee of the Central Bank will want to hold off on any further hikes and see how things pan out between now and when the year runs out. So overall, the remainder of this week, locally, obviously looking out for the outcome of the bond auction and also the outcome of the Monetary Policy Committee, while globally, a lot of the Fed speak that's happening this week, and also some of the macro data coming through from the US will give us an indication of what's going on and what we should expect in the near to the medium term. I mean, the geopolitical tensions and the situation in the Middle East seems to have escalated, particularly over the weekend, and it's led to a bit of an uptick in oil prices. Obviously, the situation between Israel and Hezbollah, we'll continue to keep an eye on that and see how things pan out. The chances of a further escalation there are quite strong, and it could have very strong potentials on the price of oil and also market direction generally. So we would keep an eye on that, to monitor things and see how they pan out for the remainder of the week. That's pretty much our financial markets roundup for this week. We hope that you have a very, very productive week. Thank you very much.